HPQ is a stock that Warren Buffett owns, and in this video I am going to do an in-depth analysis by looking at the financials of the company, the balance sheet, and using my Excel spreadsheet to calculate HPQ's intrinsic value. Starting with revenue, you can see that the company is struggling because PC sales have slowed down. They went from a high of 65 billion in 2022 to 56 currently. This is obviously a negative aspect of the company, but remember that even a company with decreasing revenues can still have value. Then, a very important aspect about this company is the shares outstanding. They have been aggressively buying back their shares. When a company buys back shares, they are increasing your ownership in the company. For example, let's say a company makes $10 a year and they have 10 shares outstanding. That's $1 per share in profit. And let's say you assign a 15p to the company. You are saying the stock is worth $15 a share. $1 a share, 15p equals $15 per share. Now, let's say they buy back 2 shares and they now have 8 shares outstanding. Now, instead of $1 per share in profit is $1.25. Assign that same 15p and you have $18.75 a share. That's what you are doing when you buy back your own shares. You are driving the price of the stock up because you have decreased the number of shares outstanding. You do nothing to the profit of the company, but by buying back shares, you have driven the stock price up. This is how a company that has inexpensive shares can drive the value of their price up. That's going to reward investors who stock with it. A good example of this is NVR, a large home builder whose stock price has seen huge returns because of undervalued share buybacks. This stock has gone up 100 times since 2000. That's an annualized return of over 19% per year. However, their revenue has only gone up 5 times, their profit 14 times, and the stock price 100 times. In 2000, they had 9.5 million shares outstanding, and today they have 3.2. They have bought back essentially 2/3 of their shares. Therefore, they are sharing the profit amongst less shareholders. This is what drives up the earnings per share, which drives up the per share value. However, it is important to notice that when they are buying back expensive shares, it's not good for the shareholder. They are still investing in something. They are just investing in themselves. It's no different from investing in another company that is very expensive. If a stock is cheap, it is better for the company to buy back shares than to issue a dividend. On the other hand, if the company is expensive and they want to reward investors, they should issue a dividend instead of buying back shares. HPQ has been trading at cheap PEs. Therefore, in my opinion, the share buybacks have been effective. Now, let's use my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I am going to do a 7-year analysis and do low, middle, and high assumptions. Let me explain the assumptions before revealing the prices. Regarding revenue growth, we have seen that this is not a growth company, and if we take a look at analysts, they are expecting this company to make 58 billion in 2027, and their 12-month trailing revenue is 56. So a little bit of growth is expected. But if we take a look at quarterly revenue, it has been decreasing. Therefore, on my low assumptions, I am going to put decreasing revenues. On my middle assumptions, 0% growth, and on my high assumptions, 2% revenue growth per year. Moving on to their margins, profit margin and cash flow margin are very similar. And as you are seeing on screen, on average, they do between 5 to 8%. I went with 5, 6, and 7 because I don't expect a lot of fluctuations regarding their margins. Then P and price to free cash flow, the average of the stock market is around 15, and you should assign a higher or lower P depending on moat and revenue growth potential. Therefore, for a company that has decreasing revenues, I am going to go very low and put 8, middle 11, and high 14. The desired annual return is the return you want to get on your investment. And because you can get around 9 or 10% investing in an ETF, if you take the risk of investing in an individual stock, your desired return should be higher. Therefore, I went with 10, 12, and 14. Now for shares outstanding. We have seen that they are buying back a ton of their shares. So I am going to put that they buy back 5% of their shares every year for the next 7 years, which is a lot. And as you can see, the valuation of the company looks very good. According to my high assumptions, you should buy the stock at 63, middle at 46, and low at 32. And the day I am recording this video, the stock is trading at $32 per share. Now you are seeing the prices without the share buybacks, just because I want to show you how share buybacks can benefit investors and drive the stock price up. Before giving my conclusion on the company, let's take a look at their dividend and debt. They currently have a 3.2% dividend yield, and they can easily afford to pay the dividend as the payout ratio is 39%. My guess is that they are going to increase their dividend as time goes on. Finally, regarding their debt, which is the difference between the market cap and the enterprise value, because the market cap is if you buy all current shares outstanding at today's market price, and the enterprise value is that plus assuming the debt and the cash of the company. They have $10 billion in debt, which is some debt but nothing that worries me because HPQ is a well-established company. In conclusion, I believe that you can make a good return on your money investing in the stock through share buybacks and dividends. I am personally not buying any stocks currently unless they are extremely undervalued, such as when Meta was under 130 or PayPal under 65, because I believe that the market is in general very overvalued. This might end up costing me, but we'll see. And remember that this is not financial advice. You should always do your own research and do not copy me. I hope you enjoyed the analysis, and I'll see you on the next one.